And now joining me is Joseph Trevisani, senior analyst at FX Street. So, Fitch analyst Chris Wolfe told CNBC yesterday that the ratings agency could potentially downgrade the banking sector operating environment. First of all, maybe just explain to our viewers so that they understand what this means, and as a result, what this could actually mean for individual banks' credit ratings, like JPMorgan's.
Certainly. Good morning, everyone, also. Well, the rating agencies they rate two separate things. They rate the general overall environment for banks, and then they rate individual banks. But the way they work their analysis, that individual banks cannot have a higher rating than the overall industry. So right now, many of the best rated banks like JPMorgan and BOA have the same rating as Fitch just downgraded the industry to. If Fitch lowered that industry rating, that would be a problem, because then they would have to reassess the ratings for many of the banks that they rate, up to 70 or 80 banks. So that's what the issue is. It's not so much what happened now, it's looking forward. If the environment for banks continues to deteriorate, Fitch may lower their ratings for the industry again, and that would be an issue for individual banks.
Right. I think the current operating environment for U.S. banks, according to Fitch, is AA-. If that goes down by a notch, it would be A+, and in turn, JPMorgan, a big bank, could be lowered accordingly. Right. So should we take the warning seriously? I mean, is this going to happen?
I don't think it's going to happen immediately, but it is something that Fitch is certainly looking at. I mean, the issue for banks, of course, is that if their ratings are lowered, that means that their profitability, their cost of doing business rises. They have to pay more for bonds that they issue and items along like that line. So it is an issue, but I don't see that it's going to be one that's going to be immediate, because at the rate the U.S. economy is growing, it doesn't seem like we're going to run into this problem based on a recession or a deterioration in economic conditions.
So, I mean, what are the issues then facing the bank industry, in your opinion, that would justify a downgrade of the environment?
Well, it's interesting. You can tie this in with the Fitch downgrade last week of U.S. debt. And what it's speaking to specifically there is political issues in D.C. and the apparent inability to run anything less than $1.5 trillion deficit every single year. Over time, that deteriorates the U.S. economic condition rather dramatically. The U.S. is currently paying over 8% of its income, U.S. government, in interest rates, in interest charges on its debt. So that's the background. If, in fact, they continue to deteriorate, then it would affect the banks as well. I don't see that for the moment, but it is definitely the trend for the U.S. economy and the U.S. debt.
So is the biggest threat here, I mean, for individual banks, that it could increase borrowing costs for the banks as their credit rating lowers? Absolutely.
That is the biggest problem for banks, especially for smaller banks that have, shall we say, more specified portfolio of types of loans out there. Another issue, which was not addressed by Fitch, but is also there, is the continuing real estate problems in the commercial real estate space in many urban centers that many banks have loans out to. That's an issue as well, since those many urban centers have never recovered their occupancy rates after the COVID lockdowns. But primarily, it's a cost of doing business for interest rates.
And they could pass on this to consumers as well.
Oh, most assuredly they will, but it will also diminish some of the demand for loans and things like that, which are part of the bank's profitability. But yes, it is an issue as interest rates rise, and that is the uncertainty right now. Is the Fed finished raising interest rates? There are many opinions on that, but it certainly is a possibility that the Fed will resume its interest rate increases. That also enters into this.
So when a bank's credit rating is lowered, that essentially means they're riskier, right? So do they need a higher credit rating to maintain profit margins?
No, they don't. I mean, banks will maintain profit margins. The problem is, in a variable rating, it impacts their profit margins by extracting profits. They have to pay more when they borrow money and things like that. So that's what the issue is. It's not that there is a great problem with default risk or anything like that for the bank's business model. It's that their profitability diminishes as their rating levels and their rating goes down.
So do you think there will be any long-term impact if it does in fact happen that a large number of U.S. banks are lowered in terms of their credit rating?
Yes, I think it would have a pretty substantial, it would certainly spook the stock market greatly if that started to happen. And that's probably its biggest impact. You know, there were arguments over when S&P a decade ago lowered the U.S. credit rating. It really didn't have any effect. The U.S. issues debt in its own currency and is the largest treasury market in the world. So the issue isn't that. For banks, though, and for stocks and the industry portfolio in general, it is an issue if the rating agencies lower bank measurements.
Should there be any concerns of a banking crisis?
No, I don't think so. I don't think this relates to that at all. And this doesn't relate to anything that happened back in March with Silicon Valley and Signature Bank. Those were specific items related to their balance sheets and their inability, or shall we say their carelessness in managing their own balance sheet. This is not the same issue. What Fitch is talking about is an overall, a general deterioration in the industry because primarily of rising rates from the Fed, and secondarily because of some particular business problems related to commercial real estate. That's my analysis. That was not Fitch's. Fitch's says that it's primarily because of rising interest rates.
Do you think if borrowing costs are increased, that sort of acts as a de facto interest rate hike by the Fed?
It does, but the Fed is doing, you know, the Fed is running a two-track program as it always does, and it has to. The first part, of course, is the Fed funds rate, but it wants to maintain commercial rates at a higher interest level than they were before because that also works greatly on inflation. The Fed was very careful at the last meeting not to indicate that they're finished raising rates because they don't want those commercial rates to come off.
Let me just ask you a side question. Do big banks like JPMorgan pay for these ratings?
No, technically they don't. I'm not sure quite what the relationship is, but I do not think that these overall ratings that you get from places like Fitch and S&P and Moody's are related to any sort of business that the bank does.
All right, okay. And how does this impact the consumer if the overall environment is downgraded and then accordingly individual banks are downgraded?
Well, it would affect their portfolios, their 401ks. It might affect mortgage rates and things like that that consumers have to pay. But overall, consumers pay much more attention and are much more dependent on the job market. And if we look at the job market and we look at the retail sales numbers, we see that that is still sufficiently strong enough to keep the consumer spending, and we know where that leads and what that means for the U.S. economy.
All right. Thank you so much today, Joseph. Always great speaking with you.
Thank you very much for having me.